Hey, today we're going to talk about the basics of the financial markets. In this video, we're going to cover about what is the financial market, who are the players, and what role does it have in the well-being of a society. So, one of the main players of the financial markets are obviously the financial institutions, especially the big ones like banks. The big banks are the most important players of the financial markets and one of the biggest. Banks like example are SBI, Federal Bank, Punjab National Bank, etc. etc. And then the second most important players are the lenders. We all know who lenders are. Lenders are people with enough capital or cash with them who are willing to lend their money to a person who needs capital at that moment for a given interest rate. And then the third most important player of the financial market is the borrowers. The borrower is the person who does not have the capital to conduct an activity or anything. So they actually need the capital right now. Now, in this case, the bank acts as a middleman. The bank acts as an intermediate for the lenders and the borrowers. So you may ask, like, why? Like, they can directly go and conduct their business, but obviously that happens in some parts of India. But the lenders and borrowers don't want to be taking up risk, especially the lenders. Like, they don't want to give their money to someone, and then if that borrower just runs away, then lender's money is just gone. So what the lender needs is security. So the bank provides a security. What does the bank do? They provide a security. They actually go and investigate. They go and question the borrower, like, why do you need that money? Do you have a stable income? Like, if I go and go to the bank and then ask for money, they probably won't give me because I don't have a stable income. So there is no chance for me to repay that loan. So they already conduct all their homeworks, the bank. So the lenders don't have to worry about that part. Only the part lenders have to worry about is so that the capital actually is there with them, so that they can give the money to the borrowers at a fixed interest rate. So how does this happen? So let's just say this is person A. So he has some extra cash from his salary. He already spent it on various things, and then he has some extra cash. Let's just say it's $100. So he didn't feel safe to carry that $100 in his pocket and just walk around. He was scared of theft and something. So he went there and deposited the $100 in his bank. So this is the bank. And he went there and deposited the $100 to the bank. And the bank said, for depositing the money here, I will give you the principal, that is the $100, at 1% interest rate per annum. What does this mean? All this means is that after 1 year, person A has $101. How did that happen? Because bank A here gave 1% interest rate on this money for a year. So the person A obviously accepted it, and he went there and deposited, and at the end of year 1, person A will have $101. So for this example, let's just say this is not a fixed deposit. What is a fixed deposit? Is that the bank actually locks the money for some time before you can actually access your own money. It's part of the agreement. So for fixed deposit, it will be higher rates of interest because the person A cannot actually access the money whenever he wants. So in this case, just a savings account. So person A can access the money like whenever he wants in that 365 days. But obviously what happens is not that the bank keeps his share of $100 always with them. They lend the money to the borrower. As I said earlier, the borrower is the person who needs the money. So they lend the amount to the borrower. So obviously the bank does not give away all of the $100. They actually keep a percentage of the $100 as a reserve. So this is termed as reserve requirement. RR. What does reserve requirement means? In the United States, the reserve requirement is 10%. What this means is the bank is obliged to keep 10% of the $100 as reserve. So why is that? Because like the depositor can come to the bank at any time and demand his money. It's part of his rights. So they keep 10%. 10% of $100 is $10. They keep $10 for for the depositor, and they lend away rest $90 to the borrower. They keep 10% and then lend away 90% of that money to the borrower. In India, the reserve requirement is 15%, which means they keep 15% of that person's money and then lend the rest 85% to the borrower. So obviously, Indian people consider Indian banks as a safer investment than the American banks because of the reserve requirements. Not only reserve requirements, there are various other factors which we'll discuss in later videos. So they lend away $90, which is 10% of the which is 90% of the original amount. So obviously they don't just lend away that money plainly and then tell you can pay this whenever you want. They lend away at an interest rate, just like what they did for person A. They offered an interest rate, and in this case they demand an interest rate. In this case, let's just say the interest rate is 3%. 3%. What this means is the borrower has to pay the bank 3% of the sum he took after a year. So after 1 year, the borrower has to pay the bank at 3% per annum. So obviously in this example, it's clearly visible that the bank makes a profit. How? Because the bank gives away 1% of $100 and then demands 3% of that 90. So the bank pockets the difference. And now you may ask, why are they keeping only 15 or 10% reserve requirement? Because the demander can go and demand his full amount at any time. So obviously you have to realize that the banks are extremely large. Like they handle hundreds and billions of dollars like every day, every year. So 10%, like they keep 10% of every deposit, 10 or 15%. So if person A comes and demands for $100, they give 10% of $100 and they take 10% of someone else's account and then give it to them, because there is a really less probability that all of the depositor at once goes and demands the full amount. So obviously the bank, this is how the bank fulfills everyone's demands. Now, moving away from the big banks, the financial markets are divided into two parts. One is the money market and the other is the capital market. So the money market is generally referred to as a short-term investment. So people actually lend and borrow for short amounts of time. It usually ranges up from around 3 months to 12 months. Under a year. So person A might go and borrow money from person B for around 12 months at 2% per annum or whatever. So these are short-term investments. So if a company needs to raise capital, they can go to the money for a short amount of time. They can go to a money market, issue bonds, and then repay the amount after 12 months. We'll come to what bonds are, but those are issuing debts. Those are a tool to collect money for your everyday requirements. And in capital market, you guessed it, it's for a long-term investment. It generally ranges from around 2 years to more than 10 plus years. So in capital market, people or companies or even government lend and borrow for longer periods of time, like 10 years, 20 years, 5 years, 3 years, like that. So even in capital market, it can be split into two. One is the equity market, and one is the bond market. So what is the equity market? I advise you to watch my what are stocks introduction, so you'll get a clear idea of what is equity. So in equity market, company raises capital by issuing shares of its own company. So what is share means? So if you buy one share of Reliance, you automatically become a part owner of the company or a part owner of equity. So when they issue shares, they bring in new people to the company, they bring in new owners to the company. So a company can raise capital by issuing equity, issuing shares. So that's why most of the big companies are issued on the stock exchange, because they had to raise capital, so they issued shares in the stock exchange. And now bond. Many people get confused with bond and debt. So what bond generally means is the company also needs capital. Just like the equity case, they can also issue bonds. So it just means they make debt for themselves. So instead of a company A going to a bank B and borrowing money from them, they can easily go out and then borrow money from people who are interested in this company at lower interest rates. So I'll give you an example of bond. So generally a bond certificate looks like this. It's written IOU. IOU is literally IOU means I owe you money, I owe you this, I owe you that, like that. So I owe you. So let's just say in this example, person A went there and lent his money of $100 to a company B. So what does lending this money to a company means? It just means that person A bought bonds worth a given amount of dollars or given amount of rupees or whatever. So a bond certificate generally looks like I owe you $100 in 10 months or in 2 years at 2% per annum. What does this mean? In this certificate, it's clearly mentioned that this person went there and bought bond certificates from this company. What that means is they went there and lent this money of $100 to a company ABC. So in return, the company gives them a bond certificate of I owe you $100 in 2 years. So this 2 years is also called as the maturity date. Maturity date is nothing but the period where the bond becomes the period where bond expires, period where you get your money back. So $100 in 2 years means $100 in 2 years at 2% per annum. At 2% per annum means $100 starting. After a year, 1 year, it became $102. How? 2% per annum. The company gives you 2% per annum interest rate for lending that money. So if we bought bond certificates worth $100, after 1 year it will turn to $102, and after 1 year, again after 1 year, it will turn into 102 times 1 plus 0.02. How do I get this? To calculate an interest rate change from one point to another, a positive change, all we have to do is multiply 102, multiply the given principal times bracket 1 plus interest rate in decimal. So 1 plus 0.02. So this will be 104.04 if I'm right. 104.4. So this person had a 4.4% interest rate, 4.4% gain from this investment. He got 2% after 1 year and then 2% after another year passed. So he got $104.4 from the bank. So this is generally how a bond certificate looks like, and these are the ways in which a company can raise capital, either by equity, by bonds, or by going to the bank. So hope you understood the basics of financial markets. We will be covering more in-depth videos in this, and hope you enjoyed. Thank you.